Hello everyone and welcome to our channel. My guest friend here, Mickey. I'm glad you're here again.
Thank you.
We already missed you. So the last video, like you tremendous value. Like I had people sending me stuff and asking me, messages and whatnot. So it was great. So I hope you had fun and you
I
were
appreciate
comfortable.
you having me. Thank you. This is not my comfort zone, but I'm happy that you chose to have me back.
Yeah.
It means a lot.
Absolutely. And I trust your opinion, which is definitely awesome.
Thank you.
So having said that, we see a couple of differences, and that's what we would like to talk about today is extended amortization rates,
Got it.
HELOC,
Yeah.
line of credits,
Yeah.
car payments,
Yeah.
boat payments.
I know a lot.
You know what I mean?
Every little thing that impacts
Right?
qualification.
Yeah.
Right?
So what's going on, like with the extended amortization rates? Well, what does that mean, like when you go into first?
Got it. So amortization is essentially the amount of time it would take for a borrower to pay off the entire mortgage in totality. So if you're, let's say, a first-time home buyer buying a home with less than 20% down,
Perfect.
These mortgages have to be insured, so the maximum amortization is limited to 25 years. Now,
Okay.
because, and you probably hear it, that it's either 25 or 30. If it's 30-year amortization, the payment would be a little bit lower, which means the qualifying payment, which means when we throw a stress test on it,
Got it.
it would be a little bit less with a 30-year amortization than if you were to pay the whole mortgage in 25 years, because now you're taking a short period of time and to pay the entire mortgage balance off.
Got it.
So
Okay.
the shorter the amortization, the tougher to qualify, essentially.
Oh, okay,
Because you're
okay.
paying it all in a shorter period of time.
Shorter period of time.
That's right.
So if the amount is the same,
Yeah.
and now we are extending the amortization rate to 30, 40, 35, 40, like what's the max now? What are they doing?
And that's a great question, because we were kind of like the max that we could go was 30 years, but now we have access to some of the credit unions or some of the alternate lenders, which are okay to allow you to pay this off in 35, even 40 years, which means that if you were having a hard time qualifying,
Right.
that extended amortization would allow you to now be in the market and qualify a little bit more, which might be a make or break in some instances, because it helps you qualify for a home that you previously were not, because that extra 5 or 10 years will drop your payment.
So
which
that's
means,
the key.
That's right.
So that's the key.
Just
so the payments will drop.
That's correct.
Because the amortization is longer.
That's right, because
On the same amount, I guess.
exactly. On the other side, is also will take you so much longer to pay it off. So now,
Right.
and then one of the biggest things is like I don't want to have a mortgage payment until I'm like 90, 100, which is absolutely fair. Like no one wants debt for any longer. than
Forever,
we need
yeah.
to, right?
Well, we need to have it though. Come on.
And I think that's really where the key is. It's like personal preference always, but it's like it could be a make or break that, okay, do we get into the market today and help an extended amortization get us what we need, maybe for a 1-year term,
And solve a problem. Yeah.
and then like hopefully as the rates do tend to drop, then we can kind of go back and re-qualify for the same amount a year, 2 years from now,
Right.
for even a shorter amortization. Keeping in mind, amortization doesn't mean that you're locked in for 40 years. Amortization just means how long it would take for us to pay off the entire mortgage balance. A term is the term where if you pick a 1 year, 2 year, or 3
So
year.
that's the agreement, the
That's
term
the
that we sign up. So that's why, ladies and gentlemen, you hear stuff like 1 year lock, 2 year,
That's
3
right.
year, 5 year. I guess is there 7?
There are 7 and 10.
7 and
Most
10.
people kind of like pick a max of 5. Even though people have picked 10 years, a couple of years
Yeah.
now would have been a great
Right,
option.
yeah.
It's just there's also like the other side too, because the longer you pick, and then there's a lot.
You're kind
that
of
could
locked
change.
in that
That's right.
in that agreement.
And then the
Understand.
penalties on a fixed rate are relatively higher than a penalty on a variable rate mortgage, which is like your mortgage rates and payments could fluctuate with Bank of Canada making announcements on increasing or decreasing the payments.
So it's interesting. You say you mentioned variable rates.
Yeah.
Now there are different types of variable rates in terms of because we all hear different stories. But can you just clarify for everyone, because some people had their variables, but they did see every increase that happened.
That's right.
For the past 6, 8, 10 increases that we have.
That's right.
Every single time they felt it.
Yeah.
And then some said No, we didn't feel it.
Yeah.
Why?
That's a great question. Now, depending on, again, institution to institution, some banks might do it that every time Bank of Canada increases rates, your monthly payments it goes up.
It goes up.
To make sure that our original amortization, let's say if we started off at a 30, it would never take us longer than 30 years to pay it off based
It
off
remains
these
the same.
Exactly. So all that's happening is on a monthly payment, as rates are going up, more it starts to go towards interest than principal.
Got it.
And because we technically are increasing payments to account for the total amortization, that would have to be adjusted because now the rate is actually higher that you're obligated to pay on a monthly basis. On the other hand, there are variable mortgages with institutions where they're like, okay, even though the rate's going higher, we're going to keep your payments the same. Now, as opposed to 30, it'll take you 33, 36, like 40 years. So, and then the amortization keeps increasing till you hit a point where the monthly payment is now no longer enough to cover the entire.
What does that mean? Sorry, what does that mean? No longer enough. That means that the interest on that particular payment reached 100%.
That means
is that what that means?
Exactly. That means like whatever you're paying now is just enough to cover the interest only. There's absolutely nothing being paid back on the principal.
And what happens then?
So in that case, now depending again, institution to institution, some institutions might send you a letter saying like, now you've hit a trigger point, you've hit a trigger rate that we need to bring that amortization back to what you originally agreed upon, and that's why. In the last few months, a lot of institutions have kind of like sent in letters saying that, okay, now your monthly payment needs to be adjusted. So all of a sudden, clients experiencing no changes on their payments and now have gone up $1,500, $2,000, depending on, again, how big the mortgage is. Now, because this amortization had gone out so far out that the monthly payment is not enough to pay any principal back on a monthly or a bi-weekly basis. So they need to kind of bring these mortgages back into the original amortization.
So it's called the trigger rate.
It's exactly.
Interesting. So what like we also hear a term from mortgage brokers like yourself and people on the street and us realtors and whatnot. It's called the blend rate.
Got it.
What is a blend rate?
Like a blended rate?
Yeah, or a blended rate.
Let's say if you have a 5-year fixed mortgage today, and then 2 years down the road you've sold that house, and now you want to take that mortgage onto the new house. Depending on, again, institution to institution, if you qualify, because anytime you sell and you buy, there's a big myth that because I already have my mortgage, it'll just be transferred over to the new house.
Okay.
No, so anytime there's a sale and purchase, that mortgage needs to be requalified now because your situation could have changed, your income could have gone up or low, credit could have changed, so the institutions will requalify given that time when you're changing, the property's changing ownership. So because it's a fixed mortgage now, if you were to just sell, there's a huge penalty involved depending on, again, what the rates are at that time. But if you were to sell, and if you choose to, or let's say you qualify with the same institution and you want to keep that mortgage with the same institution again, if usually 9 out of 10 times, and again, this is also depending on,
of course,
so throwing a lot of depending on, but
of course,
that's literally because every situation could be different. If your new mortgage is higher and now you're going from, let's say, a $500,000 mortgage to a $700,000 mortgage, your $500 or whatever is left will remain on the same rate.
Got it.
The extra $200 that you're borrowing at that time because you need a little bit more to qualify
for it. Got it. Yeah.
So that would be given at the rate and at the term at that time. And then what you're essentially doing, or the institution's essentially doing, is, as opposed to us paying a penalty on it, they will hold this rate and then they'll take a look at the $200,000 or whatever rate that is, and they'll blend it together to make sure now that you have a blended rate for that one big mortgage of $700,000. So that's, I'm assuming that the blended rate.
That's exactly what I'm asking. So if someone purchased a property 5 years fixed, and
or any fixed,
whatever the case is, example 5, they have 2 years remaining at a rate of 3%, and they're going today at the rate of 5% for the remainder, or the additional. So they would take the 3 and the 5 and they would blend it for the entire amount.
Exactly. And then because you have a heavier mortgage on the 3 and then the extra is on the lower, so this will more heavily be skewed towards the 300, which is at the 3%, sorry, and then that would kind of keep your interest rate a little bit closer to less than 4 essentially.
Right. Okay, that's interesting. So what happens? So what happens to someone that had a variable rate mortgage?
And they had to sold their house.
And they sold their house.
So Anytime you have a variable, regardless, like
Got
it's
it.
like a 3 months interest penalty that is applicable when you sell. Now, again, depending on which bank you currently bank with, some banks might say that, okay, you can sell it, you can buy another property and take the mortgage with us and we'll reimburse you the 3 months interest up to, it could be a year, it could be within 90 days, or some banks would be like, okay, you've sold it, we'll keep your same amount and the variable rate as is, and as you get into your new home, if you need an extra 100,000, we'll give it to you based off of a separate interest rate or term going at that point. So it all really just depends on which institution that you're with, because there's just different institutions have different policies on different terms.
Right. But the mortgage amount
Yeah.
is how does that work? Because
so they'll have a shelter. It's almost like if you have 300,000 now and then you
Right.
need an extra 2, in some institutions they'll just give you another 500,000 for like, here's the rate. And some institutions will be like, okay, now you have a total.
The carrying over is like with variable, you still carry.
Can. Yeah,
okay,
there are institutions that will allow you to carry. There's institutions that will be like, no, we need to discharge this completely.
Oh, discharge,
and then a new mortgage would be given to you based off of the terms going at that time. So variable usually, relatively, it's a little bit more flexible, because with variable mortgages, you can, if you choose to, fix it at any time you decide, as long as the fixed term is greater than the remainder term of you taking that mortgage. So that you do have the option to do so. You also, if you ever have like an unforeseen circumstance and you need to sell it, you can, at the very least, you can sell it, discharge the variable, and it's a 3
months rate or whatever the case is. Yeah. Okay, fine. So one interesting, I don't know if you call it a phenomenon or if you call it whatever you want to call it, but we both believe it is very important to be stable. Let me use the word stable. And when applying for a mortgage, when purchasing a property, not to do anything in between. Buy a new vehicle, both, change jobs, right?
Yeah.
Fair?
Yes. If you're going to go ahead and make purchases which can directly impact your application, it's preferred not to.
What is that? What you said, directly impact the application?
The way mortgages are calculated is your total income based off of your total liabilities. So liabilities meaning like if you have a car payment for $500 a month.
Got it.
Or if you have a student loan that's like another $150, $200. Like whatever that monthly obligation is, that needs to be taken into account from the lender or their underwriter to make sure that based on our income on a monthly basis, are we able to sustain this new amount that we're adding on to our affordability. So anything that has a monthly obligation will impact our qualification.
So I also heard stuff like, no, I just bought the car, but don't worry about it, because like by the time the bank figures it out, like I already be qualified. I don't think it works like that, because it's kind of like you kind of signed it, right? Like
to be honest, like if it's a true representation, because if you do have that liability, it's not even about what the bank finds out, but truly
it's about what's going to happen.
If you're getting qualified for an X amount based off of your numbers today, and you go ahead and sign up for another $1,000, then it's really ideally not a healthy thing to do, even regardless if the bank finds out or not, because you're actually taking on that liability, and then that means that that's leaving less on a disposable income front from day to day that you might have ideally like to kept to spend for going out or like meeting friends, dinners or whatever. Like, so it just boils down to, yes, like obviously qualification is extremely important, but it's also like holding ourselves accountable to make sure that we're not stretching ourselves too thin.
Okay, I understand. Well said. Okay, so I'm just trying to absorb everything. So, but it's okay. But it can also help by reducing that liability, right? Like, have you ever had like situations where you told your clients like, listen, if we could get rid of that, X amount of your vehicle, your application, mortgage application or the amount that you're.
Yes, because it happens a lot of times when, like, let's say it's a company vehicle and then you're paying like $500, $600, $700 a month, and now you've personally co-signed for it, or like it's showing up on your credit bureau, because even though and there's ways to justify that to the lender as well, but any direct commitment or an obligation impacts. So like a $500 a month is like almost equivalent of having $100,000 in terms of a mortgage, because mortgages are amortized over such a long period of time,
right?
And car loans are maybe 5 years, 6
Right.
years, right? So, and it's the exact same amount that you could have gone. So it all depends if you are in a position. So let's say if my client has like an extra 20, 30,000 sitting down in savings, and this car loan is really help or prohibiting them from getting another 100,000, I will tell them, as opposed to putting this towards a new home, we're better off clearing
Smart
that car
move,
loan,
basically.
because it allows you to be now more competitive and to get what you need
Smart
to get.
move.
That's right. So it's all about like what is ideally going to help us get closer to what our goals are and what our objectives are.
So I know you don't have a calculator in front of you, but let's say on a variable rate, how much monthly is it? $100,000. Like if you put it into perspective, I know it's an OPEC, depending on the amortization, depending on the interest rates, roughly.
Yeah, like 100,000. Let's say $500 now, based on the rates today. Now 600, 650. It could touch 700. It all does depend on how long do you want to stretch it out. Do you want to pay this off fast? Also, ideally, it's always good to start off with a higher amortization and then choose to pay more, because when we, let's say, start off and take off on a mortgage, it is most of the times, if you're a first-time home buyer, you're getting into this new commitment that you're not used to. So it's good to have the option to take a look at your monthly expenses, start off with, let's say, 25 or 30 year, depending on what you qualify for. And then if you're still having left with a lot of disposable funds on a monthly basis, you can take that and put towards your mortgage. Anything you pay on top, because most banks, most lenders will offer you a prepayment option, meaning you can now choose to pay more towards your mortgage. Anything that you pay on top pays down your principal. So that helps you reduce your amortization. But let's say if you do that, and now 6 months, 7 months down the road, you're like, okay, like I increased it too much and I need more money left over. Because you started off with a 30 or 25, it gives you the option to now reduce the amortization should you choose to. But like, let's say if you just start off with like, I want to pay off my mortgage in 15 years, and 6 months, 8 months down the road, you're like, okay, no, I need to reduce it. Then it becomes very challenging, because now you have to go back to the bank and re-qualify everything. So from like that perspective, it's always healthy to have the option to pay more and pay off the debt sooner, but not be restricted with now having a higher payment because you chose to pay it off so fast, and now we can't really go back and like reduce it if we had an unforeseen circumstance or a job loss, or it just could have been anything, right? So it's good to be prepared.
And it's good to be prepared, and also saying like talking to the people in the industry, talking to reliable people, talking to full-time people. Let me add that one too. Like I see it in my industry, and you know what, and I'm not blaming anybody. Like everybody is trying to do whatever they can or whatever they want. But what I'm saying, it is important to get the information from the right source, because on the street, you know, everybody is they have different opinions, they have different maybe experiences or whatever the case might be. So the difference between HELOC and line of credit.
Okay, so HELOC just means like it's home equity line of credit is what it means. So it's attached to your home. Line of credit just means the line of credit. It could be an unsecured, it could be a personal, which is essentially unsecured, or a student line of credit. So it could be an S-lock, E-lock, all these like banking terms. But it's home. HELOC just means it's against your home. So you can essentially borrow up to 80% of the value of your house, and if you have a mortgage on it already, the revolving portion, which means that if you were to pay down, what you have access to cannot exceed 65%. So if you have a house worth $1 million, you can have $650,000 worth of a home equity line of credit on it. And this is $1 million house, free and clear.
I understand.
Like there's no mortgage out there.
So no mortgage, but also having said that, do you have to qualify with your income to support up to 65 or 80, whatever?
So anything actually, and that's one of the other things too, because like I have this house free and clear, like I just want a line of credit on it. It's my money, which is right. Yes, like it is technically your money, but when you're asking for it in a line of credit where the bank's extending you that credit, they will ask for a full out qualification. And sometimes these qualifications could actually be tougher, because mortgages is like non-revolving, meaning as you pay down your monthly mortgage, you can't borrow it back. But with the home equity line of credit, as you're paying it down, it's like a line of credit, so you can borrow it back, and then
you can borrow it back.
That's right.
So once you qualify for let's say $100,000, and every time you're paying, you're bringing that monthly HELOC down.
Yes.
So let's say you brought it down to 90, you can go back again and take the 10.
That's correct. Exactly. And then that 100,000, depending on institutions, like there's
Got it.
different ways that you can access it. So some institutions allow you that you borrow 100,000, we'll fix it. We'll fix it just like a mortgage, where you can now pick 25-year or 30-year amortization on this monthly payment. As you pay down your principal, the amount that you've paid down, you can borrow from it because it's a revolving line of credit. Or you can just choose to have it open, and then you have this 100,000 balance, and on a monthly basis, you're only required to pay interest back. Obviously, that's not a healthy thing to do, but sometimes you might just need it for a quick project and you're waiting on a bonus and you just want to kind of have access to the equity in your home to do what you need to do for any other expense that you might have coming up. So you can borrow it, and then you can just, once you get paid from wherever you're waiting payment from, you just pay that down back to zero. So it's good to have access to funds.
I have a fun question.
Go ahead.
Ready?
Yeah.
Mercedes or BMW? Come on, man.
I like them both.
We have to.
I like them both.
Yeah, but if you had to pick, like let's say your own choice, like you pick
I like
for whatever reason.
I like the drive on Mercedes now just because it's comfortable.
Right.
They're both comfortable. This is hard one to pick. I like Mercedes better.
Rolls-Royce, Bentley.
Rolls.
Like, not even a question. In your opinion, a cottage or a waterfront property down south somewhere? Doesn't matter. Florida, or I know it's a tough one.
Just for the weather. Yeah, down
Just
south.
for the weather?
Yeah.
Wow, okay. Well, guys, that's it. So I hope you like this video. Thank you so much for coming.
No,
I know you're packed with your schedule
no.
and stuff like that, but it's always a pleasure seeing Mickey and all of that stuff. And I will try to get this guy after April the 12th.
I'm not that hard to get, I promise.
Well, I know, but I know you always pick up your phone, that's for sure. But April 12th, we'll see what's going to happen with these interest rates, and then hopefully you can come back and see us again.
I appreciate that. Thank you.
Thank you.
Take care.